Managing the risks associated with financing is essential for ensuring financial stability and the long-term success of apartment investments. Strategies like stress testing financing scenarios, conducting sensitivity analyses, and maintaining conservative debt levels help investors mitigate potential challenges. These practices provide a safety net during unexpected changes in market conditions, interest rates, or tenant turnover, enabling investors to protect cash flow and sustain investment returns. Key concepts in risk mitigation and sustainability. Strategies for mitigating financing risks. Interest rate risk. Use fixed-rate loans to lock in predictable payments and avoid variability. Hedge against rising interest rates with interest rate caps or swaps for adjustable rate loans. Maintain strong credit scores to access favorable loan terms. Choose financing options with realistic qualification requirements to reduce default risks. Avoid over-leveraging to preserve cash flow flexibility. Maintain sufficient cash reserves to cover unexpected expenses or periods of low income. Stress testing and sensitivity analysis are crucial tools. They help you understand how different scenarios can impact your investment performance. Regularly conducting these analyses can prepare you for potential challenges and ensure long-term stability. Simulate worst-case scenarios, such as sharp declines in occupancy or rental rates, to assess property performance under adverse conditions. Evaluate the impact of variable changes, interest rates, operating expenses, or market rents on cash flow and returns. Identify break-even points for occupancy and rental income to ensure debt coverage. Example: testing how a 1% increase in interest rates or a 10% vacancy rate impacts the debt service coverage ratio, or DSCR, and overall cash flow. Sustainable debt practices are essential to maintaining financial health in apartment investments. Limit leverage to ensure manageable debt service obligations relative to cash flow. Maintain reserves for maintenance, vacancy periods, and unforeseen expenses, equivalent to at least 3 to 6 months of operating expenses. Develop backup strategies for refinancing, loan restructuring, or equity injections during financial strain.